Financial Advisors, joined by Will Stye, also of Gulf Coast Financial Advisors. We're coming to you from the studios of Deep Fried Studios here in downtown Mobile. And we're going to be working on a webinar today called It's Not Too Late, 4 things that Gulf Coast business owners can do before the end of the year to reduce their 2020 tax burden and beyond, really. These are not short-term fixes. These are long-term concepts. So as we're going through this, as you all have seen, we can see your comments. You can raise your hands. You can do Q&A. We should be recording this. Make sure you're doing that, so Johnny. And we'll have this posted up later in case you can't stay for the entire time. But what Will and I are going to do, we're going to go through four concepts or 4 topics that business owners or professionals that have had a successful year in 2020. There's still some time. There are some things we're going to talk about that do have a 12/31/20 deadline. There are some things that can extend a little bit into the year. We're going to go over those topics that can help you defer taxes. Before I do all that, though, as I'm gathering myself and quitting my giggling, I'd like to welcome Will Stye. Man, how are you doing?
Good afternoon, Josh. I'm doing quite well. Thank you. Hopefully my mic is hot.
Your mic is hot.
Okay, terrific. Good.
Yes.
Got a hot mic. So good to be here. Good to be in sunny downtown Mobile at Deep Fried Studios working with you on this webinar.
Yeah, we had a little cold front come through last night, but we're all good now. And coming in a little bit of a hot mess, but now we're off and rolling. So Will, what I'm going to do, this is going to be kind of a quick hit. We'll run about 30, 40 minutes. We got 4 topics plus a little bonus thing at the end for you all to stick around. We're going to talk about things. None of this is stuff that is going to be unusual or things that you may not have already possibly known about. This may be a good reminder of some of the things that are out there available to business owners and successful professionals, allow them to defer taxes into the future. So Will, I'm gonna go ahead and start with the first number 1 on the agenda. Is I'm had a good year, so I'm a business owner. I'm a successful professional. Whatever it may be, I've had a good 2020. I'm coming into the end of the year, and you and I joke about it a little bit because you are a CPA by training, CPA background as a financial advisor now. But a lot of times, historically, CPAs would say, "Hey, you made a lot of money this year. You need to go buy a piece of equipment or a vehicle, and we need to depreciate that thing," right?
Yeah, absolutely. Section 179, like, come on, double depreciation. Go spend some money. Auto dealerships love it. Truck dealerships love it.
Right.
Anybody selling equipment for businesses loves that.
Well, and as the son of a heavy equipment operator, a guy that owned excavation business, I would behoove you to tell you that I've seen that in action, right? But we're not here to poo-poo that particular strategy. It's obviously worked, especially if that's a piece of equipment you actually need. What we're going to be looking at, though, are going to be some options that potentially you're getting that tax deferral in something that should appreciate versus depreciate. Now, as you all know, with our financial advisor background, we have to qualify everything. We're not saying that we have there's guarantee any of these topics we talk about have a guaranteed return, anything of that nature. It's just over time, the things we're discussing, pretty tried and true, are intended to become an asset, an appreciable asset. So with that layout, Will, what I want to start with is one of the tried and true methods a business owner can do, especially as they're kind of coming into their own, and maybe this is the first time they've actually had some free cash flow, significant free cash flows. They can look at opening up an IRA. So what I want to ask of you is let's run through the basics of the IRA, and then let's focus in on the SEP, which is something that's a fairly common thing used by closely held business owners. So let's start with the types of IRAs and what that does for a business owner.
Well, one of the opportunities available to business owner is to make the traditional IRA contribution, which reflected in 2020 numbers is $6,000. If they happen to be age 50 or older, they can tack on an additional $500 to that amount as well. So that's kind of your first step in that direction. And obviously, we're always mindful when we talk about these are retirement dollars. They're intended to be used after the age of 59 and a half. Uncle Sam's got that wrinkle in the tax code that says if you use them prematurely before age 59 and a half, there's a 10% penalty for taking out a distribution from any qualified plan. But that's the first thing is we'll see is people say, hey, I want to make an IRA contribution. Maybe there's addition to that, there's a spouse involved. They can make a contribution on their behalf as well. And then we go next here with the SEP.
Well, all right. So let's talk about the SEP because you and I, Will, we've been doing this a while, and not to pick on any CPA or any friend or neighbor or relative or anything like that, but a lot of times what we'll see, someone will walk in and they will say, hey, listen, starting to make some money in my business, and my friend slash brother slash uncle slash CPA slash drinking buddy says, well, I got to open a SEP. So let's talk about let's give a little bit of examples of where a SEP might be a potential option for a business owner that's looking at tax deferral for income. And let's look at some things that people don't necessarily consider when they just use the broad stroke of a SEP IRA.
Terrific. So SEP, SEP, commonly referred to as self-employed person, self-employed pension. IRA is the construct. There's nothing particularly special here. It's where a person would complete an application at a custodian. In our case, that's Schwab. So they would set up a Schwab account and have that be the custodian, and it would be titled, in the case of my case, it's the Will Stye SEP IRA or Trust FBO Will Stye CPA. And that's designed intended to make a clear-cut distinction about what these dollars are for, what they're suited for. Again, it's a retirement account, and it basically lets the IRS know. In this case, Will Stye has segregated money from his personal assets that he intends to use for retirement. That's where the deduction piece comes in. That's where you're able to say, hey, listen, I decided to do the limit of $56,000 for 2020. There you go, place it in, put it in play, and have it going to work for me in whatever the particular investments that I choose at that point.
Very good. Now, one thing, Will, I know that we've bumped up in the past in our particular experiences is folks don't necessarily realize that if they've got W-2 employees and they want to institute a SEP, there are certain rules of the road of how they have to treat the other employees of that group. Let's touch just loose base on that just a little bit so folks kind of know, hey, if you've got employees and you're wanting to open a SEP, there's more to it than just signing some paper and off you go, right?
Sure. Great question. That's one of those things that a job of a qualified advisor would be, is to try to help their clients, help the particular individual, in this case, business owner, navigate that. So if you have employees, and these are folks, generally I'm going to say they've earned at least $5,000 with you over the course of a 12-month period, there's actually some pretty specific language that calls for an employer to make contributions on behalf of those particular people. And that could be, sometimes people might make a SEP contribution and not necessarily consider, oh, I've got this company that I'm operating and I've got people that work for me that draw W-2 out of that company. What you don't want to run into is there's rules involved there. It's actually referred to as an affiliated service group. And those rules, the IRS basically is trying to keep and prevent a business owner from allowing themselves an opportunity that they yet deny others that are in their employ. So that's an important facet of anything a business owner that needs to consider, is to hit pause, stop and ask the question, okay, let's ask a qualified individual what it is that I can do in this situation.
Very good. All right. So Will, as we're wrapping up that part of the conversation, because the title of this webinar is, what are 4 things that people can do to defer, to get tax deferral in 2020 and beyond when they go to file their taxes, right? So let's run through, for those of y'all that are getting maybe somewhat newer to this world, or your attention is diverted elsewhere and you rely on professionals to maybe help you navigate this stuff. You've got the two kind of entry players, if you will. You've got the traditional IRA. Some would refer to that as a rollover IRA. That is a pre-tax contribution. Now you can fund a traditional IRA from startup, and you're going to have contribution limits, like Will mentioned earlier, of $6,000 per year. And then you get a catch-up. If you're 50 years or older, you can put another $1,000 in there. Now, if you're rolling a 401k, an existing 401k at a previous place of employment into a traditional IRA, that $6,000 limit does not necessarily apply, right? There's more to that story than what I'm just saying in one sentence, but you don't have a $6,000 limit on the rollover portion coming out of a 401k plan. The kissing cousins, if you will, to the traditional IRA would be the Roth IRA. The Roth IRA, as opposed to a traditional IRA, which is pre-tax contributions, the money grows tax deferred. When you take it out in retirement, you will owe income taxes then at whatever your income tax rate at that time is. Roth IRA is a post-tax contribution. The money grows tax-free, and there's no additional taxes due when you pull it out in retirement. No earlier than 59.5 without penalty, no later than, I believe, 70.5 or 72. It may have changed on me. 72, thank you. All right, so then you say, okay, well, that's great, $6,000, I can put in there $1,000 catch up. That's wonderful, but that's not going to fund my retirement, particularly if you're a business owner that's got a pretty healthy K1 and you're living a certain lifestyle. You'd have to work many, many years at $6,000 a year to make up that. You say, well, I want to put in more. What are my next options? Well, then you can look at a simple IRA. And a simple IRA is kind of it's a way to, a lot of times you and I use it as kind of an entry level for someone that desires a 401k plan, but maybe doesn't necessarily have the assets that are coming into the plan right off the bat, or maybe isn't looking for all the additional recording and reporting requirements. It's a way for somebody to get in. It's named pretty accurate. I think it's a simple IRA. It's kind of an IRA that functions in a group setting. The individual limits on the simple IRA are $13,500. There is a catch-up similar that you would see on the Roth and the traditional. All right. So you say, great, now I got $13,500 to work with. I can offer this to my employees, 100 or less on the limit. There's some matching things I have to do there, so on and so forth. We'll continue that conversation if you all want to reach out to us directly. Then the next step, as we're working our way up the chain, is the SEP. So you hear these numbers and you think, well, that's great, Josh, that's great, Will, but there's no way I'm going to fund the lifestyle I want at $6,000 a year or $13,500 a year, and however that increases over time. What is my next step on the IRA world? Well, now we're talking in the SEP. That's what Will and I were just talking about. For 2020, the limit was $57,000. Now you're talking about something that's got some pretty significant horsepower coming to the table as far as retirement savings. Will, anything you want to add to that before we move on to the next piece with the next evolution in our conversation here?
I think it's important too, as we're discussing these tax deductions and the ability to save on taxes. I had a business owner, quite frankly, remark it was almost oversimplifying things. But he said, the thing about my qualified plan is I don't spend that money. And it seemed a very blanket statement, like, well, of course you don't spend that money because you've got these other dollars. He said, no, it gives me peace of mind to know that I've got money stashed away for the rainy day, for the time down the line when I am planning to retire and I want to use it. So it's got, has more implications than just the tax savings component. It is, essentially setting money aside from yourself that it's got to get a little bit beyond arm's reach to get back to. And in some cases, I noted that premature distribution penalty that comes at a cost. So it helps people, organize their financial life in a way that they know that they've dedicated money towards retirement, and it gives them a peace of mind that they wouldn't otherwise be comfortable with there. So,
all right. So, well, let's bottom line this thing. You're a business owner. You've had a good year. Your situation makes sense for you to open up a SEP. I've got two things. One, what is the deadline for 2020? Let's talk about that. And then I've got one more final piece to add before we move on.
No, good question. So the deadline for the funding of any qualified retirement plan is the later of either your filing of the return or the date of extension. So let's just use a Form 1040. Most people typically are going to file on that. That's April 15th. If you extend that return, and for whatever reason there's pieces that you can't pull together fast enough for your tax return prepared to complete, you could extend that out to October 15th of 2021. So, there's a pretty good window here between 3.5 months up to 9.5 months away that a taxpayer would have the ability to, again, make the contribution. The contribution goes into the custodian credits the account, and that's what gives rise to the employer, the business owner, being able to take the deduction.
Okay. All right. And let's bottom line this thing. All right. $57,000 in tax deferred contributions for 2020. Let's say, we've got Alabama at 5%. And let's say that they're running in the mid 30s range. So let's just throw a total all-in number of 42%. Is that fair for a business owner?
That would be right. Correct.
All right. So I'm not going to tell you all. You can see the video. I don't know if you can see, but I'm doing this on a calculator. So if you do 42%, I'm going to round. You're looking at roughly $24,000 in tax deferred savings for the year, right? Not bad.
Not bad.
Okay, very good.
Good start.
All right, so if you all are interested in IRA options, you can reach out to us. Individual retirement accounts, we can discuss Roth, we can discuss traditional, we can discuss simple, and we can discuss SEP. All right, so Will, I'm going to move. Now we're going to transition. We were talking about the individual retirement account world. Even though some of those accounts, like the simple and in some situations the SEP, will tend to bleed over into the group setting, really when people think about a retirement plan, a qualified retirement plan in a group setting, more often than not, the 401k comes to mind, right? So what we want to do is let's talk about, particularly as it relates to small business owners, the ones that are listening, hopefully potentially listening to this recording. Most of y'all have at least some experience with 401k. Maybe you worked at a place where one was offered. You kind of understand the general, the basics of it. Pre-tax contributions, just like with your SEP, your simple and your traditional, tax deferred growth, and then you owe some money in retirement when you start taking the money out, and eventually you have to in the form of RMD. So we know these basics. What you may not have realized is the Secure Act earlier this year, and do not confuse that with the CARES Act. These are two separate things. The Secure Act was already in play before COVID hit. The CARES Act is related to COVID and some things that they did around retirement accounts and some other things related to COVID. The Secure Act had offered, we'll want to talk to you with your CPA background, is offering a tax credit specific to 401k startup plans, right? Which generally speaking is going to be a small business, right? Most of your larger businesses are going to have some type of qualified plan in place. So let's talk about, as somebody has moved in, the business has grown enough, or they think they're ready for an actual 401k, but they haven't started it yet. What's some things that Secure Act has done to make that at least a little more appealing for 2020 and beyond?
So the Secure Act is a piece of legislation that was passed at the end of 2019. It was actually December of 2019. And what it set up for was any business owner who establishes a plan, who implements a plan on or after January 1 of 2020, there were a couple of tax credits which could apply in their situation. So again, folks, for purposes of clarification, a tax credit is a far better thing than a tax deduction. Tax credit means that dollar for dollar, whatever you spend is reduced from your overall tax liability rather than a deduction, which is some percentage of that, as Josh just calculated, 42%. This is a credit's basically 100% deduction. So for a business owner that has grown, matured, find themselves in a stage of the business life where they say, what we really need here is a 401k plan. Okay, great. Well, the good news is that as you implement and begin to establish that 401k plan, any of the expenses that you pay, and oftentimes we'll encourage the company, the business owner that makes the decision that they're going to go ahead and pay those costs out of pocket. And then what will happen is for every employee eligible that you have, they don't necessarily even have to participate in the plan. You make it available to them. Like, hey, listen, you're here. We appreciate you. You're full time. You've been here working. We want to reward you with an opportunity. Well, that particular employee will bring with it $250 credit for each employee up to 20 employees, which again, if you do the math, 20 at 250 is a $5,000 tax credit is available to that employer for purposes of having established that plan. If the employer makes a decision to go a little bit further and does something that automatically enrolls those people, there's an additional $500 tax credit available for that piece of the puzzle.
Very good. Okay. So let's kind of recap again. What's the bottom line? So again, you are a business owner and you're at a point where you've had a profitable year. And also, probably you're looking at long-term, how do I start taking this business asset and start setting myself up with some personal assets? Well, the 401k, a lot of times business owners view it as, well, I'm doing this strictly for my employees. Maybe they fail to realize, hey, I can structure this with the profit sharing and everything else where I can make a pretty sizable tax deferred contribution as well, right? Not dissimilar. It's not to the penny, but not dissimilar to the limits on the SEP, right?
Correct.
All right. In addition to what the little cherry on top, if you will, this year is with the Secure Act, is they are offering a tax credit on the expenses that are involved with starting up a 401k plan. Because whereas not that things are free, there's always a cost involved with anything that's worthwhile doing. The cost with setting up a SEP, a traditional Roth, they're fairly minimal, right? Is that fair to say? Well, and not that a 401k is horribly expensive, but there are some additional costs. There's TPA costs. There's paperwork. There's filing reports. And what the Secure Act has done is they've given you away, like Will said, with a tax credit, not a tax deduction, but a tax credit in order to help fund that startup plan. So you got kind of a double thing going there. You're looking at some tax deferral in your contributions to the 401k plan. You're also looking at a tax credit to help you fund the startup of that 401k plan. And Will, I hate to put you on the spot because you and I didn't get a chance to talk about this, but are we, with 12/31/20 coming, I know, the title of the webinar is things we could do by the end of the year. We left ourselves a little bit of wiggle room because, quite honestly, with 2020, you got to have wiggle room in some of your decisions. When would someone need to look at, start putting this to place if they wanted to start making contributions, having their employees make contributions in 2021?
Obviously, I usually tell people it'd be about a 60-day ramp-up time between the time the decision's made to move forward and implement a plan and the time that you, let's say, go live with payroll. So at this stage of the game, here we are into December, I would be looking at February 1st, maybe the first pay period, middle of February, as being that starting point for the 401k plan. And what that does is some people may say, well, I lost out in the month of January. Okay, there's a way to navigate that, and for the 11 remaining months of the tax year, incorporate whatever they may have missed on the first month. But that's generally what we're seeing is about a 60-day window.
Very good. All right. So now we're going to be moving into our third topic. And if you all are interested having the further conversation on the 401k plans, both startup and existing, just reach out to us. We also offer benchmarking services. We can have the conversation directly. So now I'm going to pretend I'm taking Will Stye's pulse as we move into the third topic. And I can tell you, I know him well enough to know that when we're talking traditional and Roth and SEP and even Secure Act a little bit, his pulse is not quickening. But this third topic is something that I've noticed it gets a little juiced about this part of it. So as we're moving into the third topic, I'll put you on the spot here. We got a business owner. So use it as a case scenario. We got a business owner that has they've already done all this stuff we talked about. They have max funded their qualified retirement accounts. They've done it. They've done the reporting. They've done all the hard work. Well, and now they're looking at this and they're saying, man, I have got not only additional income coming in, I've had a good year or good years and a projected what looks like it's going to be a good future, at least in the near short term and near long term. I've got these extra funds that I'm going to owe a pretty significant chunk of change on taxes. I don't mind paying taxes. Most of all our clients, they'll pay their fair share, but maybe it's a year where they're like, daggum, I've really got some taxes here coming, and I've got an appetite for additional retirement savings. So, Will, I'm going to let you run with this one a little bit. There's more than one way to skin a cat in this, but we want to talk specifically about an option that a lot of small business owners may not realize exists to them, and that is a cash balance plan, something that they can layer on top of their existing qualified plan retirement savings. So you want to take it from there on options for that business owner?
Yes. So where Josh is leading us to here is a discussion around additional savings or additional appetite, if you will. It's like, hey, listen, I realize 57,000 is a pretty good start, but let's say I'm earning $250, $300, maybe $350,000 a year. Over time, there's probably not going to be enough time to accumulate those 57,000 annual contributions in order to make a significant impact in being able to replace, let's say, a $300,000 a year salary. So what happens is that business owners, they're basically adopting a page out of what we all knew back years ago was the traditional pension plan strategy. And that is, there was maybe a Fortune 100 company would say, hey, listen, we're going to have you and you're working for us. We're going to set some money aside on your behalf, and that money is going to be available to you in retirement. You're going to get a monthly check from that. Well, that same methodology was used to create, and where we're seeing this more commonplace is in the sub 50 employee market. So if I have an employer that's got less than 50 employees, this can begin to make some sense. And it gives them an opportunity, typically age 50 or older. They're approaching retirement and sometimes more quickly approaching retirement. And their window for being able to save for retirement is shortening. If I have a 60-year-old that's shooting for age 65, well, goodness, you've got just 5 years left to retire in. You really better sock it away. And in those instances, what we see are the contribution amounts. When you run the actuarial calculations and doing all these things within what the tax code allows for, we're seeing sizable amounts of dollars that are able to be contributed to a plan, 150, 200, 250, upwards of $300,000 being set aside for that business owner in a special account, again, a custodied account that will allow for them to have access to it in subsequent years to be able to use for retirement purposes. That's what, at its heart, a cash balance plan is designed to supercharge, if you will, the employer's ability to save money for retirement. Now we have to keep in mind we do that with the benefits going to other employees. Hence, that's the reason why we're seeing it in a sub 50 employee numbered company, a number of employees at a company market segment, because for whatever we do for the owner, yes, in fact, we will make contributions on behalf of other employees, but there are ways in doing that allow for the owner to have an advantage. If I've got a 60-year-old owner and a 30-year-old staffer, obviously the timeline says I have to save more for the owner than I do the 30-year-old, and that's where that efficiency comes in that we like to call it. More money can be allocated for the owner versus just a rank and file employee. Sometimes see this in professional groups. Yeah, absolutely. Physician groups, law firms, other professionals, engineering, you name it. We're seeing that because really what we're talking about is a ratio between the business owners and support staff tends to be pretty narrow. Maybe for every one business owner, there might be 4 staff people. Well, that's a pretty good ratio. What doesn't work is if you had one business owner and 150 employees. Well, that obviously changes the dynamics of the situation. So professional service groups, employers that find themselves at a stage of life where, hey, I've paid down my mortgage and my ability to support my lifestyle is more than then some. I'm making $500,000 a year, but I'm only spending $200,000 to support my household. What do I do with that extra $300,000? This is where we're seeing a resurgence in the use of cash balance plans.
Perfect. And folks, I want to tell you, because as you've noticed, we have kind of walked up the ladder of the tax deferral opportunities. If you start kind of at the bottom with the traditional IRA, that $6,000 limit with $1,000 catch up. Look next at simple, then you start getting into the SEP and or a fully funded, maxed out 401k plan. Now you're looking at, with the cash balance plans or anything that you layer on top of a fully funded qualified retirement account. Now you're talking, you can get into what most folks would consider a fairly sizable number, right? It really for most people, puts some significant horsepower behind the retirement plan, right? Definitely. It's also a lot to digest. It's not, as we, generally speaking, as the numbers get bigger, as the IRS allows for more tax deferral, there are going to be more rules around that tax deferral. There are more boxes you have to check. So I would highly encourage you all, you heard us talk about it for about 5 to 7 minutes, but go visit our website, gulfcoastfa.com, find the Business Owner Center section on there, and among various topics, you will see cash balance plans, you'll see non-qualified deferred comp, a variety of those things. On the cash balance plan particularly, you're going to see a deeper dive on things, because there's things you need to consider: affiliated service groups, controlled groups. There's other things that factor there. There is for that additional significant potential tax deferral, there's also some other boxes that you need to make sure that you check. All right. So, Will, I'm gonna go ahead and move into the fourth option. Now, this one's a little different. We had 3 ways for business owners to defer, taxes in 2020 and beyond. Opening and or max funding an IRA, opening and or max funding in 401k. And then number 3 was, well, if you've done both of those in some degree, maybe look at layering an additional plan on top of that in the form of cash balance plan. This one's going to be a little different, and I think it's kind of unique. It's a unique subject for 2020, because what we've seen in 2020 in the market, in just broad strokes, is you've seen certain industries and even drilled down to certain companies that have had significant losses, particular to the COVID situation, hospitality, cruise ships, things of that nature, where you're not quite sure when or if those things are going to recover, maybe years down the road. But contrast that with much of the overall market, particularly in tech, at least as far as the stock market is concerned, has done great, right? So, you're somebody that we've been, the first 3 items we talked about were qualified accounts. You make a contribution that has some type of tax preferential treatment. In return, you get this either tax-free or tax-deferred growth, but you have some rules around how you access that money. For this particular topic, for saving money for business owners in 2020 and beyond, this is going to be more for your non-qualified accounts. This will be like your brokerage accounts, if you will. And it's a topic called tax loss harvesting. Now, the horsepower behind this, Will, just to be fair for the people watching the webinar, we're not talking the same size numbers as with a SEP or cash balance plan. This is a little different strategy, but it's a strategy where someone may look at positions that they hold that they're not quite sure when those things are going to recover. They may be, to compare to that, they've got some positions that have done very, very well, made quite a few capital gains in a non-qualified account, and add in a third element there, whereas they may not have necessarily the time horizon or the tax situation where they can wait out some of those paper losses, if you will. So, Will, I'm going to kick with that framework. I'm going to kick it to you, kind of briefly describe tax loss harvesting.
Josh, you're doing a great job going along there with that, my friend. But yeah, tax loss harvesting, you're looking back over positions in a portfolio that's been created for you over time. If you're not working with a qualified advisor should be doing this along the way, every step of the way. But if not, certainly engage somebody to help you do that. But basically, you're looking back over your portfolio and identifying things that you've bought over the course of time that aren't worth what you paid for them. So the current market value is less than what the cost that you paid for it. And what that means is you have an unrealized loss. And where it turns to our attention, and one of the strategies that we're discussing here, is to say, let's make that go from unrealized loss to realized loss. Again, we're anticipating in situations, it's going to take a while. Maybe it's the Carnival Cruise Line example that Josh had just made, or maybe it's the
Hotel chains,
a hotel chain, or a fast food restaurant that's a national brand that's got publicly traded. So any of these things that potentially has been hit hard by COVID, it's down in price. Go ahead and sell that. And at the same time, hopefully you don't have a portfolio comprised entirely of losers, but you got winners in there as well. And the thought process would be is to sell positions for which you have a gain that can be netted back against the losses, up to $3,000 on an annual basis, that you get to use the $3,000 loss within your tax return. So you're not going to pay any capital gains on that. You're going to realize the losses at the same time realizing gains in good positions and placing yourself, essentially, it's a strategy. It's not going to have a huge impact, but every little bit helps if we're looking at it that way. And so long as you navigate some rules called the wash sale rule, which means you don't buy those positions back that you sold within 30 days. So once you get to the 31st day, hey, feel free, you can reposition some money and buy back the stocks that you sold. You can have the ability to do that, realize some tax savings. And again, if the thought is let's take advantage of putting things to work and having every little bit counts, that's a way to do it.
Okay, very good. All right, so we're going to, for you all that are watching, and we're recording this, so this audio is going to go out on our website probably later this week. There's the first 4 topics that we discussed, which were opening and or max funding an IRA, opening and or max funding a 401k, done both of those, and looking at layering a cash balance plan on top of that, and then also on a smaller degree, but still just important, with tax loss harvesting. Those are all things that you can do this year or before you're filing on some of those positions where you can save money on your 2020 taxes and beyond. We're going to throw in a little bonus feature because I know that this is a hot topic. I get asked it a lot. I get asked it at random. Should I do a Roth conversion? Now, I want to set this up, y'all. This is a bonus thing. This is not something that's going to save you taxes in 2020. In fact, it's going to cost you probably a little bit in taxes depending on your tax situation. But we'll just, so we have this recorded while we're in the mode of talking taxes, let's talk about, in general terms, what is a Roth conversion, and just a couple things for people to keep in mind, because I think it gets tossed around as a good or bad thing, and that's just not how you view it. It's not a good and or bad thing. It depends on your situation as much as any service that a financial advisor could advise. So let's talk about what's in general terms, what's a Roth conversion?
The Roth conversion is a strategy that's at its heart. The premise is I would rather pay taxes today at the rates today versus what I feel that those rates will be under more traditional setting or more conventional setting of when I'm going to take these dollars back out, whether it's 5 years, 10 years, 15 years. Some would certainly argue, if not sooner, 10-year time period, tax rates generally will be higher than what they are today. So why not go ahead and pay the taxes on dollar amounts? And again, if we have the chart, we pull it up here. But I would take out a distribution to the next level of, if I'm at the highest rate, it's 37%. So let's just use that as an example here. So if I'm at 37%, and gee whiz, the good news, bad news is you're always going to be in the highest tax bracket, Mr. Taxpayer. And this is upwards of $400,000. We've heard a lot of comments from the Biden team about tax proposals that specifically target that $400,000 plus group. I'd rather go ahead and pay my tax at 37% on the dollar rather than take my chances when it's going to revert back to 40%, and I've got a 3% savings there. Well, if I've got a $100,000 IRA that I do that with and I convert it, well, not only am I saving taxes, or I'm going to save taxes in the future by paying them now, that $100,000 that I convert to a Roth will never be taxed again. So if I'm going to let that continue to be invested, and over time, 10 years from now, that grows at 7% annualized, it's going to double, and so now it's worth $200,000. Well, the good news is I've already paid tax on $200,000 and can take a distribution out tax-free. Whereas if the same were true of the IRA, I'm taking money out not at 37%, but at 40, 45, 50. If folks recall on the timeline, going back to the days of when Ronald Reagan was making movies, if you made more than $100,000 in a given year, the next dollar was taxed at 90%.
Right.
90%. So these are the kind of things that give people pause and give them the consideration about making or going through the Roth conversion exercise is fear of future tax rates, and go ahead and dealing with it now.
Right. And as you and I always say, no one can see the future. No one has a crystal ball other than the man above. So if you are considering these things, don't do it necessarily just out of fear of the future. It needs to be part of a comprehensive conversation, and as it relates to your overall tax situation, because Will and I, you and I both have been through enough that we've seen these things done wrong. We've seen the timing wrong. We've seen them executed incorrectly. We've seen it come back and bite people in the butt, right? So it's not something that's because your cousin's buddy's uncle's brother-in-law said Roth conversion is the thing to do that you just go out and do it. It's one of those rare cases where I try not to be too self-dealing in the webinars and podcasts we do, but is definitely one of the situations where you want some professional guidance, because you're talking about a mistake that could cost you tens of thousands of dollars potentially. All right. So,
Absolutely.
All right. So, Will, as we're wrapping this up, we outlined some things that the business owner can do outside of just buying a piece of equipment or a brand new Ford F-150 and depreciating that thing. Things they can set up that hopefully will create potentially appreciating asset over time, something that's designed to provide retirement income when they decide to walk away from their income producing years. And it's things that they can, all these things that we laid out, these are not things that require, hours upon hours of your time, weeks upon weeks. Really, it's just a matter of, if you feel like you would want some professional guidance walking through them, just reach out to someone you trust. If that's somebody, Will and I, great. With Gulf Coast Financial Advisors, we welcome that phone call. If it's somebody else that you have in your in your circle, that's great too. But if these are things you're looking at as the year as we're closing out 2020, and for some industries you've probably had your best year of all time. Especially if you were in some type of digital space, digital delivery of information, you've done great. So maybe it's a way for you to look at, hey, I need to see if I can reduce my tax burden and maybe potentially set myself up on retirement. Will, any final words for a wrap up the webinar and give our disclosure?
I think we've covered quite a few bases here. Again, can't echo enough what Josh said. Engage a professional. I mean, we have the tools and any competent, qualified professional would have, but part of those things is running some scenarios on some planning software that we utilize to kind of help lay the numbers out, find out what is the bottom line.
Right. And for those of y'all that join us or listen to this audio after it's recorded, I do encourage you to visit our website. Everything we've talked about is on that website. Whether the 401k, we have a 401k forum with a deep dive, and especially with a lot of COVID relevant information. The cash balance plan is on the business owner planning page. The IRA information is on the investment management. It's all there. It's all there to find for you to peruse and consume at your convenience. So with that said, Will, I'm going to go ahead and read our disclosure. Before I do that, if you all want to have a conversation, please feel free to reach out to Will or I. You can reach us at 251-327-2124. You can set an appointment on the website that I keep referencing. That's gulfcoastfa.com. FA is in financial advisor. And of course, you can always email us. Just email jnull@gulfcoastfa.com. So with that said, let's go through this disclosure. Prime Capital Investment Advisors, Prime Capital Wealth Management, Qualified Plan Advisors, and Gulf Coast Financial Advisors do not provide tax, legal, or accounting advice. This material has been prepared for informational purposes only, is not intended to provide, nor should be relied on for tax, legal, or accounting advice. The information provided herein is not a complete analysis of every material fact regarding strategy, is intended to provide insights into our opinions. All information is presented for educational purposes only, not an offer or solicitation for the sale or purchase of any securities. Content offers commentary and generalized research, not personalized investment advice. Is for informational purposes only, does not constitute a complete description of our investment services or performance. All investment involve risk and otherwise stated are not guaranteed. You should consult your own tax, legal, and accounting advisors for engaging transactions, And basically, folks, what all that gobbledygook means is, don't, if you're ever listening to a webinar, podcast, audio recordings, dinner, seminar, whatever it may be, and you hear the word guaranteed, take note of that. It's a red flag. Do your due diligence, dive in deeper, be skeptical, and talk to people that you think you can trust. And like you brought Ronald Reagan up. I use a saying, even though I was a kid during his time period, but trust, but verify. So trust, but verify. And we highly recommend that. Everything you need to know about us is found on our website and by meeting us personally. Thank you all for joining us on this webinar.